Okay, let's unpack this. Imagine you just got, I don't know, a decent chunk of money, maybe a bonus, maybe a small inheritance. You tell two different people. Your parent, or maybe your grandparent, they just beam, right? That's wonderful. Put every single penny into a high-interest savings account. Safety first.
Uh-huh. And then you tell your, say, Gen Z cousin, and they look horrified. Like you literally just set that cash on fire. They start talking about inflation, how you should have bought the dip on some ETF you've never even heard of.
Exactly. That tension, that sort of generational whiplash between saving everything and investing aggressively. It's not just a funny story. It's really the defining conflict in personal finance right now. And honestly, it seems like it's making everyone pretty anxious.
Yeah, it really is. So today we're doing a deep dive into this generational showdown. You've got let's call it the rock-solid saving mindset of the silent generation and the boomers versus this high-risk, high-growth investing mindset that seems to be driving Gen Z and millennials.
And the goal here isn't to say who's right or wrong, but to really understand why. Why do these mindsets exist? What lessons should maybe be shared across the divide? And importantly, how do we find some kind of sensible middle ground?
Because the stakes here are, well, they're huge. We're heading into what people are calling the great wealth transfer. Some data suggests like $84 trillion could be moving to younger generations by 2045. And if these groups can't even talk about money without yelling at each other, that transfer could be messy, a real problem for everyone.
Right. So that's why we've gathered these sources. We want to look at the history, the psychology behind it all, and the actual strategies. But before we jump into the nitty-gritty, and because we are talking about money, just a very important quick note.
Yes, this discussion is purely for educational purposes. Think of it like a case study, some things to consider. We're sharing data, lessons learned from what we've seen, but this is absolutely not personalized investment advice. Always, always talk to a licensed professional before making big financial decisions.
Okay, good. So let's start with the older generation. The architects of that saving mindset. Their whole philosophy is built around preservation, stability, avoiding risk. They often focus on things you can touch, real estate, maybe gold.
Cash over credit, definitely. And a lot of them still view the stock market as, well, basically a casino. And you know what? Their philosophy made perfect economic sense back then. Their financial reality was fundamentally different from what we see today.
It really was. They lived through huge economic shocks, crashes, the energy crisis in the 70s, and critically, they remember a time when saving actually, paid you significantly.
Yeah, it's almost hard to believe looking back. We found info confirming that if you put money in a certificate of deposit, a CD, back in the 1980s, you could easily get returns up to 11%.
11%. Risk-free. That sounds like science fiction today.
Totally. I mean, if the bank is paying you 11% just to hold your cash, why would you take big risks in the stock market? It doesn't make sense. Plus, many of them had actual pensions from their employers. Guaranteed income.
Right, their security was kind of managed for them in a way.
Right.
Which just reinforces that reliance on cash and stability.
Mm-hmm. And the anxiety we often see now among boomers, based on our sources, is this fear that their kids or grandkids aren't prepared, that they'll inherit this wealth and just spend it carelessly.
Okay, so now let's flip it. Contrast that cautious stability with Gen Z's investing mindset. They seem totally focused on growth, getting into the market really, really early. We saw data saying over half, 54%, start investing before they're even 21.
Wow, that early.
Yeah, that's radically different from previous generations.
Well, they kind of feel like they have to be aggressive, don't they? It's less about greed, more about survival. I mean, think about the headwinds they're facing. Crushing student loan debt, what is it, over $1.7 trillion in the U.S.?
Yeah, it's staggering. And housing costs that have just completely shot up way faster than wages.
Yeah.
For Gen Z, investing isn't really seen as this luxury path to getting rich quick.
Yeah.
It's more like a necessary defense.
A defense mechanism, exactly, just to try and keep pace with inflation and, maybe achieve some basic financial stability down the line. It feels like a necessity.
And that feeling is definitely amplified by technology, right?
No, absolutely. Fintech, the whole democratization of investing thing. You've got apps where you can do micro-investing, buy little pieces of shares. It completely removed the old barriers. You don't need a fancy broker and 10 grand anymore. You can start with $50 on your phone.
So, okay. Older generation, cautious stability. Younger generation, necessary risk-taking. What's the key piece of wisdom Gen Z absolutely needs to grab from their grandparents' playbook right now?
For me, it has to be discipline. And that deep, deep aversion to consumer debt, you see this really strongly in some cultural contexts. Like we found examples mentioning the Asian American community, often paying cash for big things like cars, avoiding credit card interest like the plague.
Right, not financing stuff you can't actually afford.
Exactly. That discipline, that habit of accumulating steadily and avoiding interest payments, that's timeless, foundational stuff.
And maybe the most crucial lesson, the one young investors seem to skip most often, the emergency fund.
Yes. Bedrock of the saving mindset. Sometimes younger folks pour every spare dollar into investments because they're so focused on, time in the market, compounding.
But that's where things go wrong, isn't it? We see this all the time.
It's the classic failure point. You skip that, say, 3 to 6 month cash cushion, then something happens, car breaks down, unexpected job loss, medical bill, and suddenly you're forced to sell your investments. Maybe at a loss because the market's down.
Turning a paper loss into a real, painful financial hit.
Exactly. The emergency fund is like financial armor. It protects you from bad timing.
Okay, so that highlights the strength, the defensive power of the saving mindset. But let's flip the coin. What's the danger zone of only saving, especially in today's economy?
Oh, the cost of inaction today is huge.
Yeah.
If you're just saving in a traditional bank account, earning next to nothing, your money is actively losing purchasing power every single day because of inflation. This just feeds that Gen Z anxiety about never getting ahead.
That's the hidden loss people don't always see, right? Like if you take 10 grand and do that cash stuffing trend, putting physical cash in envelopes or whatever, you're literally losing maybe 3-4% of its value each year to inflation.
Compared to what? You could be earning 5% or maybe even more right now in a high-yield savings account, a HYSA.
Yeah.
So yeah, ignoring growth means you're actually guaranteed to fall behind. Painful, but true.
Which brings us right back to Gen Z's biggest weapon, time, that compounding effect.
Nothing beats starting early. The math on compounding is it's genuinely stunning when you look at it.
Yeah, lay it out for us. What does that time advantage actually look like?
Okay, so the data we looked at shows this exponential power pretty clearly. Let's say someone starts investing $5,000 a year starting at age 19. Compare that to someone who waits just 6 years, starts at 25, doing the same thing. By retirement.
Big difference.
Huge. The early starter could end up with over $500,000 more, even though they only invested about $30,000 more initially.
Wow, $500,000.
Yeah.
Just for starting 6 years earlier.
Yeah. Waiting literally costs you $500,000. That really highlights the urgency they feel.
It absolutely does. But here's the weird part, the paradox. Our sources show that even though 68% of Gen Z are investing, like 70% of them report feeling incredibly high financial anxiety. So they're investing, but they're still terrified. Why?
That's a great question. And I think it comes down to how they're investing. Quality and, frankly, education matter way more than just starting early or putting money in. We see these recurring pitfalls with young investors.
Like what?
Well, first, confusing real long-term investing with just gambling. High-risk speculation. They get caught up chasing meme stocks, riding crypto bubbles, throwing money at things without really understanding the fundamentals or the risks. It's driven by massive FOMO, fear of missing out.
And that FOMO often gets fed by, social media, right? Let's talk about FinTalk. That's finance advice on TikTok and similar platforms.
Yeah, FinTalk. And the research here is pretty...
The path to harmony. We like to call it the two-basket strategy. Basket one is all about defense.
Right. The safety basket. This is pure boomer discipline, essentially. First things first, build and keep that 3 to 6 month emergency fund, liquid cash. Then pay off high-interest consumer debt, credit cards, personal loans, anything with an APR that's killing you. Because no investment is realistically going to beat a 20% credit card rate.
Good point. And basic insurance, right? Health, maybe renters or homeowners.
Absolutely. That foundation, that safety net, it's non-negotiable.
Okay, so once that safety basket is solid, then you pivot to basket two, the growth basket.
This is where the Gen Z approach comes in, but done smartly. We're talking long-term diversified investing, usually low-cost index funds, broad market ETFs, maybe using tax-advantaged accounts like a 401k or a Roth IRA if you can.
So you're aiming for growth, but spreading the risk, letting time in the market do the heavy lifting.
Exactly. Maximize returns over the long haul with minimized or at least managed risk.
Makes sense. But beyond just strategy, there's this communication gap. right? Often rooted in fear on both sides.
Huge communication gap. And Gen Z can actually help here, respectfully bridging that gap by bringing their grandparents' discipline into the digital age.
How so?
Well, for example, helping a grandparent open a high-yield savings account, HYSA, getting their cash out of a near-zero interest account at the old bank and into something earning maybe 5%. That's a fantastic gift. And Gen Z needs to patiently explain why something like a broad index fund isn't just gambling. Use the long-term data that older folks tend to respect. Show them the history.
And on the flip side, what should boomers and parents do?
Share their wisdom. But crucially, share it without judgment. Talk about the discipline, yes, but also about surviving actual market crashes. Share the why behind their caution, the financial trauma they might have experienced.
Not just don't do that, but here's what happened when. That makes a lot of sense. And it's interesting, we found examples where modern values can actually align with this balanced approach,
Yeah.
like ESG investing.
Right. Environmental, social, and governance investing. We saw case studies of families finding common ground here. They move savings into an ESG ETF, for example. So you get the stability of diversified investing, the growth potential, and you're aligning the money with modern values around ethics and impact.
So it shows stability, growth, and maybe personal values don't have to be in conflict. They can work together.
Absolutely. It's a perfect example of finding that middle ground.
Okay, this has been a really critical deep dive, I think.
Yeah.
The big takeaway for you listening has to be that real wisdom isn't about picking a side here. It's about context. Every generation seems to have its own financial blind spots, and the strongest, most resilient strategy probably borrows from both worlds.
Yeah, it incorporates that essential discipline of saving and acknowledges the, frankly, unavoidable necessity of investing for growth today. The core principles managing risk, being patient, learning from history, those things are evergreen. They don't really change.
Whether you feel like you're Gen Z, kind of forced into taking risks, or maybe you're a boomer terrified of the next market crash. That balanced two-basket approach seems to offer the stability and the growth potential that pretty much everyone needs.
Well said.
So we want to leave you with a final thought to chew on, something provocative. The best financial wisdom often seems to live right there in the middle ground, bridging these generational gaps. So here's the question for you. What single piece of money advice from your family, maybe a parent, grandparent, aunt, uncle, did you initially just totally ignore or maybe roll your eyes at? But now looking at today's economy, you realize, wow, that was actually essential.
That's a good one. We really want to hear your stories on this. What did you learn the hard way? What clicked for you later on? Share those experiences down in the comments below. Let's get a conversation going.
Yeah, definitely let us know. And hey, if you found this deep dive useful for maybe navigating your own family money talks or just figuring things out for yourself, please hit that subscribe button, maybe give us a follow so you don't miss our next analysis.
We'd appreciate it. Thanks for tuning in.
We'll see you next time.